top 5 stocks popular investors are buying. There's a lot of interesting names through this 13F cycle. There's a lot of new names. One of them I'm going to talk about it. Sunbelt Rentals is a really interesting one. But I'm going to talk about the other ones as well. Those were the 5 most purchase stocks in this 13F round for Q1 of 2026. I really hope you enjoy it as always. The first one, and this is number one by far, it's Microsoft. Microsoft is still down 10% year to date, despite the S&P going up and the Nasdaq and everything else. Now, I posted this tweet about Chris Hohn's portfolio that he trimmed 83% of Microsoft. And Bill Ackman replied to my tweet, and he said that he actually bought Microsoft and sold Google, while Chris Hohn sold Microsoft and bought Google. So it's a kind of the opposite trade, you could say. And it's going to be interesting to know who's going to end up being right. I personally believe Bill Ackman will end up being right, meaning I believe the right trade is to sell Google and buy Microsoft. But we'll see what happens over the upcoming months or years. You also have Bill Gates selling 100% of his Microsoft stock, and that's really freaking out a lot of investors that maybe he believes Microsoft's going to get disrupted, or maybe something major has changed within the company. And there's a lot of discussions around this subject. Now, for me personally, I like to keep it simple. I look at Microsoft's business model and I try to look at what I'm getting. Maybe 365 is a little bit vulnerable, maybe a little bit, but I don't think it's a lot, especially whenever their offerings are on-premise, they're on cloud. And if you are on the cloud with Microsoft Azure, it's really hard to switch away to something else or to vibe code your own 365 like a lot of people are believing. LinkedIn is definitely not going anywhere. Azure is not going anywhere, growing like 39 or 40%, massive growth. And then you have Xbox, that's not going anywhere, and Windows is not going anywhere. And they have so many businesses, they're not going anywhere. Then Microsoft has a pretty big backlog, about $633 billion, okay? Now, they told us that more than 50% of the backlog has nothing to do with OpenAI, and this backlog is growing 27% year over year. So that shows you that Microsoft is diversifying away from OpenAI. I believe OpenAI is fine for the next at least 2 to 3 years. They have a lot of funding to meet the obligations, especially if the company goes public. I think they'll be fine for at least 3 to 5 years, in my opinion. Now, if OpenAI is still unprofitable 3 years from now and the stock's going to go to zero in 3 years, I believe Microsoft will be fine. I believe that's more than enough time for Microsoft to diversify away from OpenAI. They have such an amazing business, and they're diversifying as fast as you could imagine, and they have a few years to do so. So am I really worried about the OpenAI risk? I'm personally not really worried about it. Then if I look at how much I'm paying for Microsoft, again, I'm keeping it simple. I'm paying about 22 times earnings. So if I was paying 35 times earnings for this company that could potentially get disrupted of 10% of the revenues or 2% of the revenues or 5% of the revenues that could get wiped out because of AI or whatever, if I was paying 35 PE, I'm like, okay, that's something serious. I have to reconsider that. But I'm paying 22 PE for Microsoft. Yes, it could get disrupted, but I think a lot of it is priced in. Yes, OpenAI is a risk, but I think that's also priced in. Microsoft is trading lower than where it was when OpenAI actually launched. So this is something that a lot of investors get caught into. They get caught in the sentiment. There's always a reason why the stock should go lower, why the stock should be cheap. But I also saw a lot of reasons, and people were justifying why Microsoft deserves 35 PE. Now they're doing the same thing, and they justify why it deserves 20 or 22 PE. But I personally believe those risks are real, but I'm paying the right price for a company like Microsoft, and they're growing rapidly in earnings per share, 20% 2024. Last year was 16. This year is expected 23 to 24. You have the Azure business. It's not going anywhere. You have the company with an amazing CEO. They're diversifying away from OpenAI. OpenAI likely has 3, 4, 5 years. They have enough funding. And within the next 3 to 5 years, Microsoft would have diversified away. And even if OpenAI goes to zero, I think 5 years from now, Microsoft will be fine. And at the current valuation, I believe OpenAI is more of a call option than actual bet on Microsoft. Now, the second one is Amazon. Amazon has done really, really well year to date. This is an amazing company. It's my largest holding in my portfolio by far. And the reason why I like it so much is because of what I would call the physical moat. So maybe Microsoft could get some disruption. Maybe Meta could get a little bit of disruption from TikTok or maybe some kind of competition. But no one's going to disrupt the logistics or supply chain of Amazon. You're not going to go on cloud and code a warehouse or code a trucking business or code logistics and air freight and all of that. You can't do that stuff, So no one's going to disrupt Amazon. I don't see any business in Amazon that could actually be disrupted. I'm being honest. I look at the company, I just don't see it. AWS is a beast. The physical stores are beasts. They have the supply chain. They can deliver it now in 30 minutes or an hour, and they're expanding this business in a major, major way. They even got into the chip business. They're doing 50 billion annually on the Trainium 4, which is sold out before shipping. So you could imagine what kind of things the company is in. They're also in space with Amazon Leo. They're in so many different things. Yet the market was, and it still is, punishing the stock mainly due to capex spending. Now, if you look at price to operating cash flow, the company is only trading at 14 times operating cash flow. 14 times is really cheap for a company like Amazon. But the main sentiment, again, around Microsoft, around Amazon, around Meta, around all of them, but especially Amazon and Microsoft, is the whole notion that they're spending too much on AI, and then they're just, capex is too high, and they're taking on a lot of debt, and just capex in general. Now, if you look at what this capex is producing, it's producing pretty amazing results. The company is reaccelerating in growth in AWS like never before. From 17 to 20, 23, 28, they could potentially reaccelerate further. You have the CEO of AWS telling you that AI compute will be capacity constrained in the next couple of years. Despite all those investments, they're still going to be constrained. He said, we will sell every single server and wish we had more. Do you really not want them to invest in capex? What do you want them to do? Give them dividends or buy back the stock and let Microsoft, other companies take over? They're seeing the opportunity to grow, to take market share. And do you really not want them to spend the capex? For me, I want them to spend the capex. Let them spend it now. Let them grow into it. Operating cash flow has been growing like crazy. And once they grow to a certain level, then they can decide to monetize the cash flow and maximize the cash flow anytime and start doing buybacks. But I much rather the company reinvest in itself than give it to me as a shareholder through a buyback or a dividend. So I support Amazon and what they're doing. For me, any dip on Amazon is a buying opportunity. Anytime I get a 10% plus dip, I buy a little bit more of the stock and I hold it for the long term. And I have a lot of conviction in the company, and I think it's only getting started. Now, the third most bought stock by amongst, you could say, the popular investors or super investors was Meta. Meta has been extremely weak this year. It's down 5% relative to, again, an S&P 500 that's up 8, and the Nasdaq's up like 12%. Now I'm trying to keep the video short, and many investors were really worried because Meta has declined for the first time ever, I believe, in daily active people. So this is the total number of people that are on the Meta ecosystem every single day. It's about 3.5 billion people, which is crazy. It has been growing every quarter except the last quarter where they declined by about 20 million people. And people, again, on X, they told me Meta is declining in users. The company has peaked. The company is no good or whatever. And that's really, really bad. But if you really read the footnotes, and it's not really too hard to read, they would tell you that was due to internet disruption in Iran. So there was a lot of restrictions in Iran. People couldn't access the internet on a daily basis, but you also had restrictions on WhatsApp in Russia. And I have some friends over there, and they told me about it. And, that's really hurting the company on those things, and they declined by 20 million people. So it had nothing to do with the company not performing well or the company doing anything wrong or the company peaking in growth. And even if they peaked in growth, they have access to 2.5 billion people. They can launch Threads tomorrow and generate pretty amazing revenues. They can launch any app tomorrow and monetize it and advertise it to half the population on Earth for free. No other company could do that. So that's pretty amazing to me. Now, if I look at Meta, I'm really shocked by the growth of this company, that despite the company being over $2 trillion, they're still growing 33% revenues. That's really impressive to me. And it's the same story with Meta and Amazon. The whole thing around CapEx, that the company is spending too much on CapEx. Well, if you look at Meta, they spend 62% of their cash from operations on CapEx in 2022. Now they're spending also about 62%. Now, if you look at what happened after 2022, after they spent so much on CapEx, revenue growth, or actually revenues, went from declining to growing 20%, and it's still growing 20%, in fact, 33% till today. So I believe those CapEx investments have paid out in a major way. The company is seeing a lot of efficiency in terms of AI. They're not hiring, they're even laying off about 10% of the workforce, which is not a good thing. But for the company, again, they're finding efficiencies within AI. They're growing while maintaining headcount. Microsoft is doing the same thing. So those companies are finding a lot of efficiencies within AI, and that's pretty amazing to me. Now, looking at the valuation, I'm only paying 18 times earnings for Meta, 18 times earnings for the platform, for having access to 3.5 billion people, for WhatsApp and Facebook and Instagram and Ray-Ban smart glasses. They've been popular and all these things. 18 times earnings is really cheap in my opinion. But again, you have the main worry of most investors is that those stocks will never really perform, mainly because they're spending so much on CapEx. And I'm not going to say look at Google, but I'm going to tell you the way I think about it. And the way I think about it is, let's assume those companies or those stocks remain flat for the next 2 years and they continue to grow at the same pace they're growing at right now. Okay. In the case of Meta, right now we're paying at about 19 times earnings. Okay. If they grow 12% next year and the stock is still flat, the P would be 17 times. Okay. In 2028, so 2 years from now, if the stock is flat and they grow another 14%, we would be paying about 14 times earnings. Do you think it's likely for Meta to trade at 14 times earnings? Do you think the market is that inefficient? I'm not saying it's efficient, but I'm not saying the market is stupid either. Do you think 14 times earnings is likely on Meta as something that's permanent? I'm not saying a crash. I'm saying something that's permanent. I personally don't think so. So I don't see how Meta or Microsoft are going to be flat for 2 or 3 years, because if they do remain flat and they keep growing at such pace of growth, they're going to be trading at like 10 times earnings and 12 times earnings. And I don't see how the market's going to let that happen. So I have a lot of conviction in Meta as well, and I own it in my portfolio. Number 4 is Visa. Visa is an interesting one. It's down 10% year to date. It has recovered some of its losses, but the stock is still down on the year. This is an amazing company with over 51% net income margins. Many people right now are asking me, what is the best hedge against inflation? And I try to tell them Visa, because whenever you have the transaction, like let's say the price of gas right now, okay, let's say the prices of gas are, let's say 50% higher on the gas station. Okay, you get your Visa card and you pay for the gas. Okay, Visa is not increasing their fee. Their fee is fixed. But because the transaction cost or the price of gas has increased by 50%, Visa will collect 50% more than they would have, let's say, 5 months ago, because the price is higher and they didn't have to increase their fee or anything. So it's like automatically indexed to inflation. So if we have higher inflation, I think Visa could benefit. They benefited in 2021, and I think they could potentially benefit again. Now, to keep the video short again, with Visa, we're paying about 23 times earnings. 23 times earnings for such a business is really not bad at all. I mean, you couldn't dream of buying Visa for 23 times. I remember it used to be trading 30, 31 times, and there was a lot of FOMO and why it's a quality company, and look at Costco and it deserves a premium. Well, now it's at 23 times. To me, that's a pretty good deal on Visa, but I'm not expecting a lot of, you could say, life-changing returns. I mean, if the multiple remains flat and they grow 12 to 13% a year, I would expect a 12 to 13% annual return, maybe 14% at most, with a 0.8% dividend. So I'm not expecting life-changing return. The main risk for Visa is Europe. and other countries moving away from US-based payments. Europe is working on one, and 20% of the volumes of Visa, they come from Europe. India already figured it out. Europe is trying to figure it out. Now, based on what I read about it, Europe is not going to phase out Visa and MasterCard. They're still going to exist, but they're going to introduce their own version of them. Okay. So it's not like if they introduce it, Visa will lose 20% of their volumes tomorrow. They might lose 2%, 3%, 5%, maybe 10% at most, you could say. And there will be a little bit more competition in Europe, not just Visa and MasterCard. So it's not really like, it's not going to be like in India where everyone uses the same system. It's going to be more like whatever they prefer to use. And in this case, it's not going to be affected as much. Even MasterCard, I think, has a 30% exposure to Europe. So MasterCard could potentially be much more affected than Visa, but nonetheless, I believe Visa is also undervalued at current prices. The last one, which is a stock that I used to own years and years ago, and it was actually a UK company. It had a different name. They listed it on the Nasdaq, I think, and they changed the name. And this is Sunbelt Rental Holding. Maybe you heard of a company called United Rentals. United Rentals is the number one market share in the United States. Then you have Sunbelt Rentals. And this is mainly a company that rents you a lot of equipment, things like forklifts, floor cleaning solutions, mostly things that have to do with construction. So construction of data centers, construction of housing, construction of factories, reshoring, the kind of industrialization team or reshoring team or deglobalization team. The best way to bet on it is with a company like Sunbelt Rentals. They get those equipments, they depreciate them over a few years, and they rent them to you at pretty attractive prices. They insure them and do all these things. And it's actually a very profitable model. I know some people that have a small business like that. They rent those equipments, and they generate pretty good returns on those equipments. So it's actually a pretty decent business. And again, I personally like it very much. The company has grown really well, about a 15% CAGR over the last 20 years or so. Over the last 5 years, it's been a little bit slower at about 11%. Adjusted EBITDA has been growing. Adjusted earnings per share has been growing as well. But my main problem with, you could say, this company is the valuation. The valuation right now, if you look at the earnings per share of $3.70 that's expected for this year, is trading at about 19 times earnings. Okay, so 19 times earnings for a company that was declining in earnings per share over the last 3 years, now is expected to grow again, maybe 6%, 15%, 14% at most. You're paying 19 times earnings for what I would call a cyclical-like industry. Okay, and you have United Rentals, which is the leader, much higher margins, much better business model, much more reach. It's well known, and they have a geographical locations and so many things. And this one is trading at 20 times. So if United Rentals is trading at 20, why would I pay 19 times for Sunbelt Rentals? So Sunbelt Rentals to me is really not too expensive, like it's not crazy expensive, but the stock is not a bargain. If I had to buy, and I used to own Sunbelt Rentals, and I had it at 16 times earnings, 16 and a half, now trading at 19 times earnings, based on the growth, and this is a cyclical stock, I would prefer to pay at about a 1 PEG ratio or 1 price to earnings growth. Now, in this case, if I take the $3.70 and I time it by 16 times earnings or 16% earnings per share growth best case, I'm getting about 59. The current price is like 76, so there's still, like 20% on the downside. So for me, the stock is not expensive, but it's not a bargain either. I think there's way better industrial and other stocks in the market. I think a lot of super investors bought it. They likely bought it in March. It was fairly valued back then. Since then, the stock's up 20%. Back then, it was trading at like 16 times earnings, 1 PEG ratio. Makes sense, But now it's almost at a 1.5 PEG for the second best in the sector, and it's a little bit cyclical. It's not good at this price. I would like the stock in the 50s, low 60s. I think the stock then would be undervalued. But that was just my opinion on those stocks. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.